Martin and Chelsea Matthews, and today we're going to talk about the importance of credit in America. Credit and debt, this is like a huge emotional issue, especially in America, because there's so many things that Americans have really like racked up a bunch of debt, and people have a lot of guilt and emotion about this. So we want to like break it down for you, because all debt is not bad debt. Okay, so let's first of all talk about the difference between good and bad debt.
Yeah, so a lot of people, we'll give you our personal belief on this. We don't believe all debt's bad. I know some people tell you debt's bad, and I know when you are feeling the crushing burden of debt, especially like credit card debt or student loan debt or whatever kind of debt it is, or personal loans, it feels like this debt sucks. Okay, we understand that. Our personal view is that not all debt's bad, and we're going to define good debt and bad debt. So here's the difference. Good debt is debt that's used to create an asset. So what is an asset? An asset is something that puts money into your pocket. So let's give an example of this. Let's say I own real estate. Let's say I own a real estate property, and I have people who live in that real estate property, and they pay me rent every month. That real estate property to me is an asset, because the people who live there, remember, people are actually your greatest asset. So the people who are in that property paying me rent, that property is an asset to me, right? Now, did I pay cash for the property? No, most real estate people don't pay cash for the whole property. They put some money down, and then they finance the rest. They get a mortgage. That's considered debt. So good debt would be, I go to the bank, I get a mortgage on an apartment building. I have tenants, people who live in an apartment building. They are paying me rent. I'm using some of that rent to pay down the mortgage, and I make more than that, so I have a profit on the property, right? So if you guys can follow that, it means that I'm using debt to create an asset. So that is an example of good debt. It would be good for me to own apartment buildings where I have tenants in there who pay me rent every month. That's considered passive income, money that's coming to me without me having to actually go out and do a lot of work for it, okay? That's an example of good debt. Now, what would you say is an example of bad debt?
Oh, shopping, racking up the credit cards, all those shoe must-haves, the sales, basically like it's bad debt is things that take money out of your pocket, and they don't put money in your pocket.
They'll
like Martin was saying about the good debt. Okay, so could be student loans. If you do not get a job or have a career or business that is going to pay back those loans and pay you more than you racked up in credit card debt, and student loan debt, I would say student loan debt is bad, bad, bad.
A lot of people might agree with you. A lot of people are defaulting on their student loans. They feel like, hey, they thought they were going to get jobs they're not getting, so they feel like that debt wasn't worth it.
I really think, this is my own personal opinion, that there are less and less reasons for college these days and taking on student debt. I would say unless you know what you want to be, like a doctor or some kind of specialized thing that you need to go to college for, I would say take a real good look and consideration before you take on these enormous student loans and take on that debt and start off your life really with this tremendous burden on your shoulders.
So let's talk about what's the importance of having credit, because look, you should use debt properly. Always use debt properly. Don't use bad debt for consumer debt that you cannot afford to just pay off, okay? So use debt properly if you're going to use debt. But if you're going to use debt for something, you need to have decent or good credit. If you're going to go buy an apartment building and you're going to get a mortgage from the bank, you need to have some good credit so that they can feel comfortable giving you that money, and also feel comfortable that you can operate that property well and be able to make a profit so that they can get paid back. The biggest thing is whenever somebody's lending you money, they want to get their money back. Okay, so how important is credit?
Oh my gosh, it's so important. I can tell you a couple of examples, personal examples of how I learned how important credit is. And the first one is when I very first tried to go get a car loan. And I wanted to get a car loan, and I applied for it, and I was told I didn't have enough credit. I didn't have any credit. I'm like, well, So it's not bad credit. I haven't done anything bad to my credit. They're like, you don't have enough credit. So I didn't have any history of showing that I'm a responsible borrower, that I can borrow money and make my payments on time. And so I had to go get a cosigner, somebody that had good credit and had good credit history, showing that, hey, if I default, like if I don't make my payments, this person is saying, I will take responsibility for it. So one thing that I started to do to actually start building my credit is I went and got a credit card, and I would make all my purchases with the credit card. But here's the key, and the very important key, is I would put the cash aside. So it's things that I would pay with cash normally, but I just paid with the credit card. I put the cash aside, and then when the bill came, I paid off the credit card.
Like what kinds of things?
So just like groceries, like, you know,
Like
if
gas and stuff
yeah,
like that?
gas, groceries. If I did go shopping, I made sure that it was like I had the cash. And so I literally would put it aside, and then I would put it in my account and I would pay the bill. Another time that I will tell you that I learned the importance of having good credit, this is when I followed the advice of somebody who did not give me the best advice. And here's the thing. We will always show you, you know, multiple ways to look at something. And so typically when you've given when you've been given financial advice or heard from some of these like financial gurus, maybe on TV, and they give you financial advice, it's not specific to your personal financial situation, which means that it might not be the right choice for you. So when we work with people, we look at there's a very specific set of things that we look at to get information about where is this person financially now and what are their goals before we ever give them financial advice. Okay, so there was somebody who you probably may be familiar with that talks about be debt free, like all debt is bad, you got to be debt free at all costs, no matter what. Now there was a church that I was going to, and this person came and gave like a financial series. And so the church is like recommending this person. They're a very well-known financial guru. And so, of course, this was many years ago. Of course, like what he says must be right. So he basically, I followed his advice, and he told us to get rid of all debt. If you have a car loan, get rid of it, even if it's going to ruin your credit, because you don't want to have any payments, you don't want to have any debt. So here's what I did. I had a perfectly good running car that I had just put some money into, but I wasn't working at the time, and so I was afraid of how I was going to make the payments. So what I did is I took my tax return, $1,800 at the time, I went and paid for a car in cash. I got a crappy, beat up old car that I paid $1,800 in cash, so I didn't have a $150 car payment. I was stressed about paying a $150 car payment, so I go spend $1,800 on a crappy car. That car, and then I gave back my car to the bank.
The car
who
that
loaned
you
me
had a
a
loan
loan,
on.
and I owed like $10,000 on it. Okay, it wasn't a huge amount, and okay, and so here's what happened. The crappy car that I paid cash for kept breaking down on me over and over and over, and I had to spend all this money on it trying to fix it. So then when I finally got rid of it, and I didn't have the cash to pay for a car that was like safe enough, that wasn't gonna break down on me and my baby at the time, and so I realized, okay, I've got to get a car loan. I have to get a car that's like safe enough for me to drive, that's not going to keep breaking down on me. So then I had to get a loan. Well, by this time I went to the car dealership to see what kind of loan I could get, and because I had given back this car, well, it ruined my credit. So I went from getting like, I think I had maybe 5 or 6% interest on my car loan that I gave back, and now guess what they want to charge me? 25% interest. 25% interest because I made this decision following somebody that I thought was a financial guru that was just giving general advice that was not for my specific situation. Yeah. So this is a totally long, roundabout way to say that we want to give you different options and different ways to look at things so that you can make the best decision to make yourself financially stronger. We don't want you to put yourself at financial risk.
Yeah. And during that time, that $1,800 could have paid your monthly payment for like a year.
Yeah, it was like ridiculous, but because I didn't
you
know
found a new job.
but because I didn't know how to think through the situation for myself, I just blindly listened to this information and made a very detrimental decision to my credit and my financial situation.
Yeah.
So we want to empower you guys to like know how to think about a situation and decide for yourself what is the best decision for you.
Look, so the importance of credit, in America today, it's vital, because all the things you want to do. Look, every wealthy person I know uses leverage, right? Leverage means doing more with less. So if I want to buy $1 million apartment building, I don't need to have $1 million cash to do it. I need to have what the down payment is if I can qualify and go get the rest from the bank. Now I can control that asset. Remember, it's an asset to me because it's putting money in my pocket. I can control that asset worth $1 million by having just a percentage of that money. That's using leverage, right? That's being able to keep my credit in a great position so that I can be able to use and do those kinds of things. So what we want to empower people to do is to think about things. Think about things for themselves. Think about things, hey, is this the right situation for me? How can I use this? How can I apply this? Because what I've learned since coming to America, I was born in Liberia in West Africa. I came to America many years ago and to finish high school and go to college. And what I learned, especially about credit and meet her, yes. What I've learned about credit and all these kinds of different things is that they're very important to your survival in America and how well you do. And so you're in a financial system here that works the way it works. And you can't change all the rules about how it works, but you can learn the rules so that you can make the best decisions for yourself. And the more educated and empowered you are, the better financial decisions you make. And what I've learned since coming to America is that just because everybody's doing something one way doesn't mean it's the way for you to do it. Just like you don't have the same occupation everybody else does. You don't enjoy the same things everybody else is doing. It doesn't mean that if everybody else does something financially, that means that's the best thing for you. Most of the time, rich people, wealthy people do things very differently than what the masses do, especially when it comes to money and credit. So credit in America is extremely vital. Access to capital, access to money for things that you want to do. Look, one of the biggest problems that businesses have, they want to grow and expand, but they don't have the capital, don't have the money to do it. That's why you see Shark Tank is a popular show. People go there asking for money. They want to grow and expand. They have a great idea. They might even have a product that's making money. But they need capital in order for them to continue to grow. For them to fulfill. Maybe they manufacture something and they need to grow, their manufacturing. Or they want to produce more of this stuff to fulfill bigger and bigger, bigger and bigger deals. Maybe a store, let's say, Macy's or a grocery store wants to order their product. They need to manufacture a certain amount of that product. Well, what if they don't have the money to do it? You need access to capital, and for that you need to have good enough credit in America to be able to do it. And if this is something you guys want to learn about, if you're watching this and you're thinking, hey, I have a business or I need access to capital, things like that, reach out to us. We have programs and different things that can help you get the capital you need in your business to continue to grow, to continue to expand. Even if you are a startup, there's programs that's available that can help you to do that. So feel free to reach out to us anytime for things like that.
It's something that we struggled with in our business and growing our business is trying to get enough people to see us and market and promote and get out there. But then it was like, okay, well, we need to increase our business. We need to make more sales. We need to do, more and increase our cash flow so that we can outflow more for marketing and promotions and all of those things. So it's like, it's kind of like a double-edged sword. It's like you need to have the capital, but you need to have the capital to grow, but you need to grow to get the capital. And so it's like the chicken or the egg. Which one comes first? You got to be able to have access to capital.
Yeah, access to capital is very vital. Look, lastly, what we'll talk about is, Chelsea, you talk about this a lot, people wanting to pay off their mortgage. And what's your view on that? Okay,
so I'm going to blow your mind right now because this is a huge thing in America, people want to pay off their mortgage. This may be you. You may be wanting to pay off your mortgage as quickly as possible. You may be paying extra on your mortgage right now. So again, we want to give you a different way to look at things just so that you can evaluate what your options are, what you're doing, so that you know that you're making your financial situation as strong as it can be. So one of the risks that you may not want to pay your mortgage off fast or faster is if you are not putting any other money aside. Okay, so let me give you an example. Okay, so let's say you're making an extra mortgage payment every single month, or every so often you're paying extra towards your mortgage so that you can pay that off as fast as possible. It sounds great, okay? It's good to have your mortgage paid off. It's good to be debt-free. It's great. But here's where you could be at financial risk.
It's good to be bad debt-free.
Bad debt-free, yes. Okay, so here's where you could be putting yourself at financial risk. Is if you are putting all your extra money to paying off your mortgage and you don't have any other money set aside for reserves, like let's say an emergency happens or you get sick or hurt and you can't work, okay? Can you go to the mortgage company and say, hey, mortgage company, I've been paying you all this extra money and now I have an emergency, so I really could use that money. Can I get some of my money back? Because it's my money, right? No, they will not give you your money back. And in fact, if you don't have a job, like if you lost your job, you can't even get a home equity line of credit because you have to have employment. You got to show that you can pay it back. So also, if the market goes down and you lose the value of your house, you lose that extra money that you paid off. Yeah. So here's another way to look at it, okay? If you want to pay your mortgage off faster, great. You could still put the money aside, the extra money aside, okay, into a reserve account, or maybe even somewhere it could earn some interest or earn some extra money, right? Mm-hmm. You put that aside, and then after the same amount of money, same amount of time passes where you would have paid off your mortgage, guess what? If you want to pay it off, cool, you have that money and maybe even a little bit more because you put it somewhere that you were earning something on your money. Mm-hmm. And you could go and pay off your mortgage, be free and clear, and it'll be awesome. But along that way, if you got hurt or sick, or you had an emergency, or something changed in your business and you needed that money, you would have it available. So that is where you're making yourself financially stronger and you're eliminating the financial risks. Okay, so I'm not saying don't put more towards your mortgage. Just look at what position are you putting yourself in, stronger or at more risk.
Exactly. And look, lots of people have done this, where they put money to a separate account and they allow that to accumulate. So when they get to, let's say somebody has a 30-year mortgage and they've been putting money aside and they do this for 15 years. They could have had a 15-year mortgage or a 30-year mortgage. So at the year 15, they got the 30-year mortgage, been paying for 15 years, and they've been putting this other money aside for 15 years. Now at year 15, they have enough money built up in that separate account. You know what they do? They never take that lump sum and just wipe out the mortgage. You know why they don't do it? Because they've seen their money growing. They're like, no, I'm not going to take all my money and just go send it there so I can have the house paid off. But when people do it every month, they don't really realize that how much is growing over time. But when you have that lump sum sitting there, you start thinking, oh, instead of paying it on this house, guess what I'm going to do? I want to take that money in that separate account. I'm going to buy a second property, and that'd be my investment property. You see how people think now the person's in a stronger financial position because they're still affording to pay their primary residence, but then they also have a secondary investment property that's now paying them passive income. So you have to look at things a little bit differently and kind of look at the picture a little bit clearer and always look at, hey, is this going to put me in a stronger financial position? And how do I evaluate that? So, and if you don't know how to evaluate what puts you in a stronger or weaker financial position, reach out to us. We're happy to help you understand the 6 areas that builds an unbreakable financial house. And we can help you evaluate how well you're doing in each one and how you can get stronger in each one of those areas.
Well, I'll tell you something else that we do that's very different from the masses when you talk about getting a 15-year loan. We don't get shorter term loans when we finance things. We get longer term loans. And it may sound not beneficial because people look at, the interest rate that you're going to pay. But guess what? that's putting more cash flow in your pocket to be putting aside, to grow, to invest in your business, to do something that actually puts more money in your pocket. So that's where we're turning what could be bad debt into good debt, because we're making more resources, more dollars available to go and make more dollars available.
Yeah. We always evaluate something. We always look at and evaluate something so that we know that, hey, any dollar we're not paying towards something, we want those dollars to be working for us. So if we can earn more than what we're paying for on interest on something, it makes sense for us to have our own money working more and earning more interest somewhere else than paying something off sooner, if that makes sense. So if I'm earning more in one place and I know how to earn more return in one place, if I can borrow at a lower rate, I would much rather do that than take my money and pay it off today. I'd rather have my money working for me and earning me more than paying something off today. So that's our viewpoint on it, is we're always trying to maximize the growth of our money and maximize the smart things we're doing with our money. And that's really how you have to look at it for you and your family. That's why credit and having a good credit score is extremely important. And one of the biggest things that make up your credit score is how much of your available credit that you use. In America, if you can keep it's called a credit utilization. So let's say I have $10,000 available on a credit card. If I only use $3,000 of that, it shows my lenders I'm a good borrower, right? Or if I use more than that 30% and I pay it down quickly, it shows my borrower I have the ability to create money and pay down that debt. Okay, so very, very important to keep your credit usage rate under 30%. That's one of the major impacts on your credit score. Chelsea talked about paying things on time and things like that. Make sure your credit utilization under 30%, and then that helps your credit score big time.
So thanks for watching. We'll see you next time.